Hello, everybody. This is Dr. Sam here, ready to do a new video with you. Today, what we're going to do is we're going to do some transactions involving introductory accounting. We're going to be looking at it from a corporation vocabulary point of view. So we're going to do a little mini problem involving a journal, posting to a ledger. We'll do a trial balance, and after that, we'll actually do financial statements. Okay, so let's get going here. We're going to first work in the general journal. Remember, that is the book of original entry. And then from there, we are going to post or copy the information into the ledger, and then we will create what is called a trial balance. Technically, the trial balance that we are doing is an unadjusted trial balance. So let me just kind of fix that real quick. Not that I needed to fix it, but when you guys eventually learn adjusting entries, that will make more sense. But for right now, we'll go ahead and refer to that as the unadjusted trial balance. If you just call it trial balance in your classes when you're, first learning this, that's fine. It's only when you get exposed to chapter 3 in most accounting textbooks, the topic of adjustments or adjusting entries. That's when you have to start playing with the titles, because not only do you have an unadjusted trial balance, you then will have an adjusted trial balance. So it's very important that you're able to keep them, identified properly. Okay, so let's go ahead and start doing some transactions. Let's pretend we're dealing with the month of April. And let's say the first transaction that we have here is, let's say we purchased some insurance for 12 months, okay? And the cost of the insurance is $1,200. So imagine that for a second. But in reality, we can't really do that, because if you take a quick peek at my general ledger, I have no balances. So I can't go out and just spend money that I don't have. So let's do another transaction before that, where the company is actually getting started. And let's say it involves, the issuance of common stock. Okay, so we need to get money into the business. So the company is, or whoever the owner of the business is, they've got to put some influx of cash into the business. So think of this as like an investment. They're basically exchanging stock for cash. So what we're going to do in that situation is we are going to debit cash, and we are going to credit common stock. And let's say the amount is $20,000. Remember that when you do journal entries, you have to follow a protocol, and that protocol is debits first and then credits come afterwards, and credits are always indented. So if you notice here, notice how my words, the debit is to the left, the credit is to the right, and my amounts mimic that formation, okay? And no matter where you are in the world, this is the process of doing the bookkeeping aspect of accounting. So you must follow this. You can't put common stock credit and then cash underneath it as a debit. That's not right. Even though your debit and credit are actually the right amounts and you've debited and credited correctly, it's not the appropriate protocol. So you've got to do it the way I show it to you right here. If you do it any differently than the way I'm doing it, you're doing it wrong. All right, so make sure you follow the right procedure. So let's color code these as we go along so that it's easy to follow. So once you've done the journal entry, the next thing you want to do is copy, or in accounting terms, you want to post it to the ledger. You're going to hear me say throughout this process, it sounds like we're doing a dance move, but it's a step 1, step 2, step 1 dance. And the general journal is what I refer to as step 1. The general ledger is what I refer to as step 2. And then what you're going to do is, after you get done posting to step 2, you're going to go back to step 1. So the bottom line here is that you're doing the step 1, step 2, step 1 dance. So try to remember that as we go through this. So we've just done step 1. Now what I want to do is copy the information into step 2. So here are the 2 destinations that we're headed towards. So let's go ahead and complete that process. So we're going to put in April 1st, nothing in the item. We'll use the item column probably when we hit chapter 3, when we start learning about adjusting entries. Chapter 4, when we start learning about closing entries. But right now, while we're in chapter 2, the item column is a ghost town. Okay, so what we're going to do is just ignore that, and then PR, think of the P, even though PR stands for posting reference, think of the P in this particular case as page. So page reference. Where are we copying from? We're copying from the general journal page 1. So we'll put G in for general and 1 in for page 1. So G1. And then what we're going to do is copy what we did to cash, and we debited it for 20. So right now cash has a $20,000 debit balance. So you got to remember that all you're doing in the ledger is in your first 3 moves, you're just copying the date, copying where you're posting from, copying the amount, and then you have to update the balance. You have to remember that this balance column is a running balance, meaning that you're constantly updating it after each transaction. Okay, let me post to, oh, by the way, now that I've posted to cash, let me go back to step 1. So step 1, step 2, step 1, dance. So what we're going to do in this PR column is we're going to put the account number. So notice the account number for cash is 101. So instead of doing a check mark, because we actually use check marks for other reasons in that PR column, we put the account number of the account we just posted to. So it's kind of like a way to really, really double check that we put it in the right spot, as opposed to accidentally putting it, in prepaid insurance as an example. Okay. Okay, so now let's post to common stock. We're going to put in the date, April 1st, nothing in the item. G1, we are now going to be crediting the common stock for $20,000, and the new balance is $20,000. Cross-reference back with the 301. There we go. So that's your first transaction. On this worksheet, if I ever scroll down a little bit, you'll see some of my little tips and tricks that I've talked about in the past. If we're dealing with corporation accounts, our debit aid, instead of being assets drawing and expenses, is now assets dividend and expenses. Debit aid accounts go up by a debit. Always remember that. The debit aid accounts go up by a debit. Of these 3 debit aid accounts, the only one that kind of goes up and down or gets debited and credited on a regular basis are the assets. So under normal conditions, you always debit drawing, and you always debit dividends. You always do debit drawing, but you always debit dividends, as you can see here, and you always debit expenses. Okay. The liquor accounts are a little bit expanded from the original liquor that I shared with you, if you've seen my other videos. So liquor in corporation lingo, the L still stands for liabilities, but now the C stands for common stock. And we have 2 R's. So instead of just saying liquor, now you sound a little bit more drunk and say liquor. So we have R for retained earnings and R for revenue. But notice that only the liabilities of the liquor accounts go up and down. But the common stock, the retained earnings, and the revenue, they just go up. So they are, what I like to call my shopping cart account. So the dividends, the expenses, the common stock, retained earnings, and the revenue, those are my shopping cart accounts. And every time you use them, they always go up. And that's why over here I have always credit common stock and credit retained earnings, always credit revenue. Okay. And then down here I have some little definitional stuff, and I also have some little tips, and that's where I want to actually talk about for right now, because this will actually help us as we're doing some of these transactions. So remember that when you're working in the journal, there's always a minimum of 2 moves. You have to have at least 1 debit and at least 1 credit. The goal is to make sure your debits in dollars equal your equals your credits in dollars. So debits in dollars must equal your credits in dollars. The first time you use any of these accounts, it has to be a plus move because you can never have a negative balance in these accounts. Books are always done from the corporation's eyes, right? So make sure you remember that. You're not looking at it from your eyes. You're not looking at it from the customer's eyes. You are looking at it from the corporation's eyes. Anytime you see the word paid or prepaid, then you see that, boom, automatically you know you're going to credit cash. So it's a great little, clue to kind of help you figure out, what are you supposed to debit, what are you supposed to credit. So if you see paid or prepaid, half your job is done. You're going to be crediting cash. And as I said earlier, if you run across any of the shopping cart accounts, which are basically your capital, your dividends, your revenue, your expenses, retained earnings, these guys, every time you use them, they will go up. Okay. So here are all of the accounts, but in particular, here are the shopping cart accounts. I want to put them in yellow. Whoops, I didn't mean to do that. I didn't realize my little symbol was so flexible. There we go. Okay, so those yellow ones are the shopping cart accounts. Okay, down in this section here, when you're looking at the impact on your stockholders' equity, I'm going to change that to common stock instead of capital. So with common stock, that's basically how you become an owner in the business, right? Dividend and common stock makes your equity go up, where dividends makes your company go down. So when the company gives its owners a dividend, the value of the company technically decreases. Revenue makes your stockholders' equity go up, expenses makes your stockholders' equity go down, and retained earnings makes your stockholders' equity go up. So this is just the impact on the equity, right? But from a functional standpoint, remember your 5 shopping cart accounts, they always go up. All right, so back to what we were doing. Let's do another transaction, shall we? Let's say now, the company purchases 12 months worth of insurance, right? So when you purchase insurance, there's a possibility in your chart of accounts or in your general ledger that you may have not only a prepaid insurance account, but you may also have a insurance expense account. So you may have an expense version of insurance and you may have an asset version of insurance. So which one do you use? Well, the one that you use is based on how many months worth of insurance did you buy. So if you had just bought 1 month's worth of insurance, then you would have to use insurance expense, which is not even an option for us to use. So, and again, in case you don't remember, the only account names you are allowed to use in your general journal are the names of the accounts that you see in your ledgers. So you can't go off and name things whatever you want to name them. You can't do that. So there is no insurance expense, so I can't even go there. So again, the question would read, we bought 12 months worth of insurance, or we prepaid for 12 months worth of insurance. Because it's 12 months worth, we're going to use prepaid insurance. So let's go ahead and put in a different color here. Let's say this was April 3rd. And we are going to debit prepaid insurance. And we're going to credit cash. So think of the transaction that I would be reading out of the book. It would say something like prepaid for 12 months worth of insurance, $1,200. Prepaid, ding, 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 ding. That's one of those buzzwords. Every time you see the word prepaid or paid, we know immediately we're going to be crediting cash. So unlike when I first tried to do this transaction, now I can afford to buy the insurance because I have some cash in the cash account. So here's the journal entry. Let's go ahead and post. All right, so we're going to put in the date, April 3rd. Nothing in the item. We're posting from G1. We are debiting prepaid insurance for $1,200. And our new balance in this account is $1,200. This $1,200 balance means debit balance because I have debited that account. Same thing with cash. Cash is a $20,000 debit balance because of the debit that I made. Whereas common stock, this credit caused this to be a credit balance. Okay. So we're going to cross-reference back with the 150. And now let's credit cash. Since I already wrote April, I don't have to repeat that. I'll just put a 3. G1 in the PR. I'm going to credit cash for $1,200. And now I got to keep a running total. I had $20,000 worth of debit. Now I'm crediting the account and our new balance is 18,800. So when you're doing the math and you're trying to figure out when do I add, when do I subtract, try to remember this. If you have something with a debit balance and you debit it, debit, you add. If you have something with a credit balance and you credit it, credit, you add. But when you want to subtract, you subtract when you have a debit and a credit. So think opposites subtract. Instead of opposites attract, think opposites subtract. Okay, so that applies here. I had a 20,000 debit balance. I credited the account, opposites subtract. That's why I ended up with 18,800. And we have cross-reference back with the 101. All righty. Let's say next transaction is, how about we buy some land on account? Now, that's really weird because you would normally take out a loan for that, but I don't have a notes payable account. All right, so you know what? Let's do this. Instead of land, let's change this because I've made up this question. So let's pretend. I know you're not normally supposed to be allowed to do this, but let's pretend the account was not called land. Let's pretend it was called equipment from the get-go because you don't buy land on account. And I want to buy some land. I don't want to buy some land. I want to buy some equipment. Okay. So let's pretend right from the get-go that the account was called equipment. Now keep in mind, you are not allowed to do what I just did. All right. I just wanted to use equipment instead of the land account. So we'll pretend that's what it was from the beginning. All right. But we can't mess around with these titles. So again, pretend that that equipment was there from the get-go. Okay. So let's say the next transaction is we purchased equipment. Okay. And the equipment cost $50,000. But we don't have 50. We only have 18,800. So we're just going to put a little money down. We're going to put like $10,000 down, and then we'll charge the rest. So this is going to require us to do 3 moves here. So let's say this is the 9th of April, and we again purchased equipment. And this equipment's costing us 50 grand. But I don't have 50 grand. So we're going to put some money down, $10,000. And the balance is going on account. We're going to be charging the balance. So we're going to credit accounts payable. And that would be $40,000. Okay, notice that in this case, I had 3 moves, and that's quite all right. I have to have always at least 2, minimum of 2 moves. If you only do 1 move, you'll never balance. Notice that my debit is 50 and my 2 credits add up to 50. Okay, got to make sure you're always in balance. Notice that I had 2 credits here. My debit has to always go first. My credits have to be indented and they always follow the debits. In all honesty, doesn't make a difference which one of these 2 credits I put first or second, as long as my 2 credits follow my debit. Okay, so let's go ahead and post. Let me draw out a little path where we're going here. And then accounts payable is right down here. Okay, so let's go ahead and post. Let's find equipment. Date is April 9th. And nothing in the item. G1, we are debiting the equipment for 50 grand. And my new balance is 50 grand. Cross-reference back with the account number 170. Then I want to update my cash, put in the 9th. Nothing in the item. G1, we're going to credit the cash for 10,000. Look how low our cash is getting. We are now down to $8,800. So hopefully we'll get some influx of cash soon. And we're going to cross-reference back with the 101. Then find accounts payable. The date, April 9th, nothing in the item. G1, we are crediting accounts payable for $40,000 and our new balance is 40,000 credit balance. Remember, accounts payable is a liability and a liability is a liquor account. Okay. First time you use a liquor account, it better be a credit. First time you use a debited account, it better be a debit. So you got to know, hey, what's a liability? You know, what's an example of a liability? Accounts payable, notes payable, wages payable. Unearned revenue is also a liability. So you've got to know what accounts are. You've got to know what category they fall under, or else debited and liquor will not work for you. So you've got to know. And down here, I have some examples. So assets, things that you own, like cash, supplies, equipment, accounts receivable, inventory, prepaid insurance, buildings, land, vehicles. Okay. Anything that ends with the word receivable is an asset. Anything that starts with the word prepaid is an asset. So assets, part of debit aid, they go up by a debit. Okay. Liabilities, these are the debts of the company. Accounts payable, notes payable, mortgage payable, unearned revenue or unearned service revenue, also considered to be a liability. If the liability ends with the word payable, it means you owe somebody money. But if it ends or starts with the word unearned, it means you owe somebody a service. And you may have heard me talk about that in a previous video. And then you got your shopping cart accounts, also known officially as the stockholders equity accounts. Okay. All righty. So back to where we were. So accounts payable, I just posted. So let me cross-reference back with the 201. All righty. So we've done 3 transactions so far. Let's do another one. Let's say in this next transaction, we perform a service. So we actually do a job, right? And let's say the job was for $15,000. So we perform a service for 15 grand. Okay, so let's use a different color here. And let's say the date happens to be the 15th. So we are going to debit cash. We're going to debit the cash and we are going to credit our revenue account, right? And it looks like we're at a amusement park, Lake Breeze Park. So the way we perform a service is by people coming into our park. So the only revenue account that we have here is admission revenue. So I'm sure the question, if you're reading it out of the book, would say something like, you know, customers were admitted into the park. So let's say we made $15,000 in admissions today. So we would end up crediting admission revenue for that $15,000. So the revenue accounts are customized to basically fit the type of earnings that the business does. Like if we were like a salon, we could have like 6 or 7 different revenue accounts in the mix, like hair cutting revenue and, waxing revenue, tanning revenue, manicure revenue, pedicure revenue, so on and so forth. So it just so happens that we happen to have just one revenue here, and that's admission into our park. So we're going to debit cash because we got actual cash, and we're going to credit admission revenue because we did, we let people through the turnstiles and now they can use our facilities. So that's how we earn our money. So let's go ahead and post. So our cash, go to the ledger, put in the date, 15th, G1. We are going to debit the cash for $15,000. And we finally got a little influx of cash, which is good. And our new balance in cash is 23.8. So do you remember what kind of a balance these are? Are these debit balances or credit balances? If you said debit, you're right, because cash is an asset. Assets are always supposed to carry a debit balance, right? So just because we credited doesn't mean we have a credit balance. But if you ever end up negative, you've made a mistake. So you want to make sure, you're following the right procedure. So cross-reference back with the 101. And then admission revenue. The date, again, April 15th. Nothing in the item, G1. We are going to credit the admission revenue for $15,000, and the new balance is $15,000. And that's a credit balance. Cross-reference back with 400. Okay. So we've done quite a few transactions. Let's do a few more. Let's see if we can get some of these other transactions into the mix here. Let's say it's now April 16th, and the transaction reads paid salaries, right, to our employees. So if we paid salaries, we're going to debit salaries expense or whatever they happen to call it. And as you can see here, they call it salary expense. It could be salary and wages expense. It could be payroll expense. Who knows? So you have to only use the accounts that are given. So in this case, we will use salary expense, and we will credit cash. And let's say the salaries were $8 grand. Okay, so let's go ahead and post. Let me put the little path that we're heading towards here. So salary expense, the date, April 16th, G1, and we are going to debit the salary expense for $8,000, and the new balance is $8,000. Cross-reference back with the 728. And then we're going to credit the cash, 16th, G1. Whoops, mistake there. Here we go. G1, we are going to credit for $8,000. And are we going to add or are we going to subtract? What do you think? If you said subtract, you are right. So we are going to do that subtraction, and our new balance is 15.8. Cross-reference back with the 101. All right. Hopefully that barking wasn't bothering you too much here. Okay. So next transaction, let's say it's the 20th. Use a different color here. And on the 20th, let's say the company decided to pay out dividends. And let's say it was like $800 worth. So the question in the book would read, paid dividends, $800. So we would debit dividends, and we would credit cash, and it would be for $800. All righty, so let's go ahead and do that posting. So put in the date, which would be April 20th. Nothing in the item. G1. We are going to debit the dividends. Remember, dividends is a debited account. Ready? And cross-reference back with the 330. And then cash be on the 20th. G1, we are going to credit the cash for $800. And our new balance is $15,000. Cross-reference back with the 101. Alrighty. So let's say it's now the 25th. Getting close to the end of the month, getting close to wrapping things up here. And on the 25th, let's say we paid for this month's advertising. So we're going to debit advertising expense. And we're going to credit cash. And let's say the advertising cost $2,000. And let me come up with a new color here. So let's post. So here we go. So the date being April 25th, nothing in the item. G1, we are going to debit advertising expense for $2,000. And that gives us a $2,000 debit balance. Cross-reference with the 726. And then cash on the 25th, G1, we're going to credit for $2,000 and your new balance is $3,000. Cross-reference back with the 101. Okay, so we're moving along pretty good here. Let's say the next transaction involves a customer giving us money in advance for using the park. So in other words, you know how sometimes you might get, companies might get, information from local amusement parks saying, hey, if you can get your employees to go for a little bit of a cheaper price. So let's say our company, our amusement park sold some of these, did some of these tickets, right? So customers gave us money in advance. So we actually owe them entrance into the park. So I can't call it revenue until the customers actually walk through the turnstiles. So let's say, here we are in April, our park doesn't open up until, let's say, end of May. So we don't have any revenue yet coming in, but we're getting the customer's cash. So it's really important that you understand this because we are under what is called accrual-based accounting. And under accrual-based accounting, you don't record the revenue until you earn it. So just because you get the money ahead of time doesn't make it revenue. So if you get money, ahead of time, all right, or the customer pays us in advance, we're going to debit cash because we have the money, but now we owe them the service. We owe them, entrance into the park when it's their turn to come to the park. So the journal entry that we would make, let's say this is the 29th, we would debit cash. So again, the question would read in the book, collected money in advance of service, right? And let's say we got $7,000 from this pre-sale. So we're going to debit cash and we're going to credit unearned service revenue or unearned revenue. So let's see what they call it. They call it unearned service revenue. So that's what we got to call it. Okay. So that would be the journal entry when a customer gives you money in advance of service. You would debit the cash, but you would have to credit the liability account. Very, very important that you identify that as a liability. So let's update the accounts involved. And let's go post. So now on the 29th, I am debiting cash for $7,000. So our balance in cash has now climbed to 20. And we'll cross-reference back with the account number 101. Find the unearned revenue account. First time in here, so it's got to go up. Unearned revenue is a liability. How does a liability go up? It's a liquor account, so it's got to go up by a credit. So nothing in the item. PR gets G1. We are going to credit unearned revenue for $7,000, and our new balance in that account is $7,000. Cross-reference back with the 209. Okay. And let's do one more. And let's say this is happening on April 30th. And on April 30th, what color have I not used so far? Here we go. I think you have it tough where you're trying to figure out what to debit, what to credit. I'm trying to figure out what color to use. Okay, so let's say on the 30th, we made a payment on account. So remember back on the 9th when we bought some equipment for 50 grand, we credited cash for 10 because we didn't have a lot of money at that time, and we charged the balance, which was $40,000. So that's like your credit card. Think of accounts payable like your credit card. Well, let's say we want to make a payment on our credit card, right? And let's say we want to make a payment of $5,000. Because that interest is going to start to accrue. So the faster you pay things off, the less interest you will ultimately pay. So on the 30th, we are going to debit accounts payable, and we are going to credit cash. So this is the journal entry you make as a business when you make a payment on account. And what did I say, 5,000? Not that you can respond to me or anything like that, but I'm pretty sure that's what I said. So that would be what the journal entry would look like. So let's go and post. Where's accounts payable? There it is. So remember, accounts payable is a liquor account. So when you first used it, it was a credit. But the only way your charge card balance can go down is if you make a payment. And liabilities can go up and down, but by the time it's all said, I better still have a positive balance. So I'm going to debit my accounts payable for $5,000. So my new balance that I owe this company I bought the equipment from is now $35,000. All right, so when I charged, my balance went up. When I made a payment, my balance went down. Cross-reference back with the 201. And finally, let's update the cash one last time. 30th, G1. My cash is going to be a credit for $5,000. So my new balance, 15 grand. Cross-reference back with the 101. All righty, so we've gone through some basic bookkeeping transactions here, and we could tell from all of our activity in the journal that I was in balance. Look at it, 8 and 8, 2,000, 2,000, 5,000, 5. So you can tell in the journal you were in balance, but kind of crazy things can happen when you post. Even though it's just basic copying, you could copy the amount wrong, you could transposition, you could add zeros, leave out zeros, you could copy into the wrong location, you could add and subtract. There's so many possibilities of mistakes. So that's why we have a trial balance. So the trial balance is step 3. So remember what I said before when we were doing the journal and the ledger. But think of that dance, step 1, step 2, step 1, step 1, step 2, step 1. And that's the dance we were doing, all right? Back and forth, back and forth, back and forth, all right? So now we're ready to do step 3. So notice what I have here. After all the transactions are complete, copy final answer from each ledger, right, into the trial balance. And let's go ahead and do that. So here's where your debit aid and your liquor are going to kick in again. So you've got to know that cash of $15,000 is a debit balance. You have to know that, or else you might put it in the wrong spot. Prepaid insurance, another asset, carries a debit balance of $1,200. Equipment, another asset, debit balance of $50,000. All your debit aid accounts will end up on the debit side of the trial balance. All your liquor accounts will end up on the credit side. So let's see if we do that and we balance. So accounts payable would be next. That's a liability, which makes it a liquor account. And that goes on the credit side. Unearned revenue, another liability, another liquor account, which means credit balance. Common stock, another liquor account, credit balance. Dividends, that's a debit aid account. So that's going to be on the debit side. Admission revenue, that is a liquor account. And that's going to have a credit balance. And then we have advertising expense. That is a debit aid account. Ends up on the debit side. And then we have salary expense, another debit aid account, ends up on the debit side. And take a look at my balance. I got 77,000 on the debit side, 77,000 on the credit side. Okay. From a red carpet point of view, you want to make sure that the first number in each column gets a dollar sign. So you see my 15 grand and my 35 grand both have dollar signs. And then my final answers get dollar signs as well. Notice that underneath the, I should say above the 77s, above the 77,000, you see a math line. That's mandatory. And then underneath the 77,000, you see double underlines, and that is mandatory. Double underlines in accounting shows conclusion. Notice the heading, name of the company, always top billing. So Lake Breeze Park. And then the next line is the name of the statement, which in this case is the unadjusted trial balance, but you guys can just call it trial balance. If you're in chapter 2 of your accounting course, that's sufficient. And then the date at the end of the period, which would be April 30th, 2022. Okay. All right. So now that our trial balance is in balance, you would now proceed to the financial statements. Now, keep in mind, we haven't learned about adjusting entries yet, which is chapter 3 in your textbook. So that's when you do your adjustments, you will go back into your journal here and you would continue in your journal and do the adjustments. And then you would start that step 1, step 2, step 1 dance again. Okay. And then after you do your adjusting entries, you will do a new trial balance, which is called the adjusted trial balance. So it's really off of the adjusted trial balance that you do the financial statements, but we don't know about adjusting entries yet. We're only in chapter 2 of our accounting course. So for practice purposes, we'll use this unadjusted trial balance to help us practice the financial statements. Okay. So, but in reality, you wouldn't do them right now. You would wait until your trial balance had more up-to-date information. Okay, so we're going to do the name of the company, which is Lake Breeze Park. And you write income statement, which is the name of the document we're doing. And then the third line, you're going to write this really long date. So for the month ended April 30th, I'm just going to write April 30 though, 2022. And make sure that every part of your heading is centered above the document. Very, very important. Okay. In case you're not sure what an income statement does, the goal of the income statement to determine profitability for the company. And you do this by going revenue minus expenses. So out of all the stuff that you see in the trial balance over to the left, the only stuff that goes into your income statement are the revenues and expenses. So let me highlight what's going in. That's all that's going into this document. So let's actually make this document yellow. So only the yellow things from the trial balance are going in here. All right. So here goes. We're going to start off by putting the heading revenue, followed by a colon symbol. That colon symbol says, get ready to indent a list of all of your revenue accounts. Well, we only have one in this case, and that's admission revenue. I need to indent that list. And the amount is $15,000. So remember that beauty salon example I was mentioning before? So if we had a beauty salon company and we had like 5 different ways to earn money, hair cutting, waxing, manicure, pedicure, tanning, whatever, I would list all of those. So, hair cutting revenue, manicure revenue, pedicure revenue. And if I had more than one, that's when I would itemize in column 1. Okay, but in this case, I only have one, so I'm going to put that 15,000 in the final column. So think of column 1 in these financial statements as subtotals or itemizing, and only grand totals go in column 2. Next thing, expenses. And underneath expenses, we're going to, because of that little colon symbol, we're going to write an indented list. So I happen to have 2. I've got advertising expense, and I have salaries expense. Now I have to fix something here. You notice I have salaries and wages. That's actually wrong because it wasn't called salaries and wages. So I have to fix that. So if I submitted this to my teacher would have taken a point off because I didn't write the correct title. Okay, so if you're one of my students and you did this, I'd have to go -1. Why? Because you didn't use the appropriate titles. So let's recap here real quick. So in the journal, you are only allowed to use the titles that are given to you in the ledger. You do not have any flexibility to change the titles, okay? When you do the trial balance is a copy of your ledger. Again, look at I didn't mention this before, but look at the sequence of the account numbers. They go from smallest to largest. So does your ledger. So we are basically copying again. So when you're doing steps 1, 2, and 3, where you do most of your thinking is step 1. Step 2, you're copying. Step 3, you're copying what your final answers from step 2 are. So don't make step 2 and step 3 hard. Don't make them, more challenging than they actually are. That's considered to be easy, right? The hard part is the general journal. What are my 2 moves? What do I debit? What do I credit? That's where you got to do your thinking. Step 2, that's easy. You're copying and, you're doing some math, updating your balance as you go. Step 3 should be the easiest thing. No matter what you did in steps 1 and 2, in step 3, you are just copying your final answers and hopefully you balance. All right. So using these same account titles, I'm stuck using those titles in my financial statements as well. So I caught an error, I fixed it. It's okay to catch mistakes. Sure, I'm human, you're human. We make these mistakes. You want to make sure these mistakes are caught before you make things official. And fortunately, I was able to do that. So because I have more than one expense, I'm going to list these expenses in column 1, right? And I'm going to add them together. And I'm going to put their result in column 2. And when I do that, I come up with $10,000 as total expenses. Let's bold all this stuff. Makes it a lot easier to see. Okay. I now need to identify this $10,000. And we'll call that total expenses. So I now want to subtract the expenses from my revenue. And when I do that, this company did well. They made money. They didn't lose money. So whenever this result is positive, when you go revenue minus expenses, you call that positive answer a net income. If that revenue minus expense math turned out to be negative, then you'd have a net loss. Okay. So we have a positive result, and let's double underline that answer. And that's what people call an income statement. Okay. Can it get more complicated? Absolutely. But you'll learn a more complicated version, not really complicated, but more stuff in there when you hit chapter 5 of your accounting course, when you start getting exposed to merchandise companies. But from a service company, this is pretty much the service income statement, right? Except one little thing I have to add, and that is a $sign in front of that too. So first number in each column gets a $sign, final answer. Now it's perfect. Okay, next thing we're going to do is a statement of owner's equity, or excuse me, a statement of retained earnings, as you see there. So let's put the name of the company, Lake Breeze Park, statement of retained earnings. And again, we're going to put this really long date. And let's turn this one, this really light purple color. Okay, so when you do a statement of retained earnings, the goal is to determine the ending balance or ending value in retained earnings. To determine the ending balance in retained earnings. And the way the math that's involved here is you start off with your beginning retained earnings, you add in your net income, and you subtract out your dividends. And this will give you your ending retained earnings. If you had a net loss from your income statement, then the procedure you would follow is you would have your beginning retained earnings, you would subtract your net loss, you would subtract your dividends, and this would give you your ending retained earnings. Those are the two possibilities that occur in here. So let's go ahead and do this. So we start off retained earnings. The beginning of the month, we didn't have any retained earnings. So we'll just say on April 1st of 2022, our balance in retained earnings was 0. And let's give that a $sign. Whoa, hello. Let me go back to where we were. Hang on. There we go. Somehow I clicked off of my screen. There we go. All right, so hang on a second. I clicked on the wrong button here in Zoom, and now I'm like, I hope you guys can still see my screen here. Let me just make sure that that's still visual here. Hang on a second. So I accidentally hit something and I'm just going to go off of it and go back on it for a second. Okay, so I think my screen did disappear there for a second. So it should be available for you to see again. Yep. Okay, so if you notice, I started out with 0 beginning balance and retained earnings. I didn't have any retained earnings, right? But now what I want to do is I want to add in my net income. So basically, I'm bringing in the information for my yellow document. I'll even make it yellow here. So we're taking, so you have to do the income statement first. Then you do the statement of retained earnings. So let me add that in. So 0 plus $5,000 is $5,000. And we don't have a fancy name for this, so we just call it subtotal. By the way, we're not even going to use this first column in this document. So we're doing a one column presentation of the retained earnings. Okay, so now I want to subtract out my dividends. And my dividends, if you recall, were $800. So really, from the unadjusted trial balance, the only thing that I'm bringing in from the trial balance was my dividends. So now I'm going to do that subtraction. And the ending retained earnings ends up being 4,200. And what we tend to do is we date the first retained earnings and we date the last retained earnings. And instead of writing beginning and ending like I did before, you would just have, 4-1 represents the beginning, 430 represents the ending. Let's give it some double underlining. And that is what we call a retained earnings statement. If we were to do the next month's, May, retained earnings, this 4,200 will appear in this spot in the next month. So your ending retained earnings from one month becomes the beginning retained earnings for the new month. Okay, one last thing to do, and that is the balance sheet. So let's put this in a different color. The remaining accounts are what you will see get copied into the balance sheet. All right, so let's highlight this balance sheet in that blue color. And again, name of the company, the Lake Breeze Park. Doing a balance sheet, but the date is the short date. So when you're doing these three financial statements, so let's include the trial balance in this for a second, right? You'll notice that the trial balance has just the date. The income statement has a long date. The statement of retained earnings has the long date. The balance sheet has a short date. How are you supposed to remember that? Well, I can tell you that the income statement and statement of retained earnings tells a story of what happened during the month. So because it's telling a story, you're saying, hey, this is what happened during the month. So for the month. And by the way, it could be for the quarter, for the year, it doesn't have to be just for the month. Okay. But the income statement and retained earnings statement tell a story, whereas the trial balances and the balance sheet, they don't tell a story. They just say, hey, on this date, these are my balances. Okay. So that's kind of like the why behind it. But if that doesn't work for you, here's an easy way to remember. Check this out. This is totally unofficial, and this is just a memory technique. So if I write the word balance and I write the word statement, which word is longer? Obviously, you're going to say statement. So anything with the word statement in the name gets the long date. Anything with the word balance in the name gets the short date. It works. All right. It's not the official. You'll never see that in any book, but it works. Okay. So let's do the balance sheet. Someone asks you, what's the goal of the balance sheet? Goal is to make sure your assets equal your liabilities plus your stockholders' equity. That's your goal, right? And it would be at a specific date. The goal of the balance sheet is to make sure your assets equals your liabilities plus your stockholders' equity at a specific date. So let's go ahead and do this thing. Now, when you get to chapter 4 in your accounting course, this balance sheet will have a little bit more stuff in it. So it'll look a little bit more full than the one you're about to see. So under assets, we had 3 assets. We had cash, prepaid insurance, and equipment. So cash, prepaid insurance, and equipment. Remember that part about the little colon symbol? So when you put a heading followed by a colon symbol, be prepared to indent a list. Because I have 3 items in my list, more than one, I'm going to be using column 1. So cash was $15,000. My prepaid insurance was $1,200, and my equipment was 50 grand. Hang on, hit the wrong button. Let's try that again. There we go. All right, so now what I want to do is I want to add my assets together. And I'm going to put the total in the total column, which is column 2. And I now want to label these guys. So I'm going to double indent so nobody makes the mistake of thinking I had 4 assets. And my total for total assets is 66.2. And I'm going to double underline that result. So half of my goal has been accomplished. So now I'm hoping that when I add my liabilities and my stockholders' equity together, that they total 66.2. So speaking of that, let's go for it. So under liabilities, I think we had 2. We had accounts payable and unearned service revenue. And accounts payable, again, I have more than one, so I got to use column 1. 35,000, unearned revenue, 7,000. So I now want to add these 2 guys together. And when I do that, I get 42,000. Hang on a second. And what would be a good name for that? How about total liabilities? Okay, do not double underline this 42, because if you double underline this 42, you're saying 42 equals 66.2, and it does not. You don't double underline again until hopefully you see another 66.2. So we got one more category to go, which is stockholders' equity. And under stockholders' equity, we're going to put common stock and the answer from our retained earnings statement. So common stock was $20,000. And retained earnings was $4,200. Okay, so now we're going to add those 2 together. And we get 24.2. And we're going to call that total stockholders' equity. And here comes that moment of truth. We're hoping, we're praying. Does 42,000 plus 24.2 equal 66.2? And it does. Yeah. and the crowd goes wild. Or at least in your head, you're so happy. So 66.2, that matches up top. The only thing left to do is to label that 66.2. So we'll call it total liabilities and stockholders equity. And that is a balance sheet. So to recap what we've done, we've gone through the general journal. We did the step 1, step 2, step 1 dance, all the way through all of the transactions. Once the transactions were completed, we then did an unadjusted trial balance. Okay. From the unadjusted trial balance, we prematurely did the financial statements because, like I said, you really wouldn't do financial statements unless you were working off of an adjusted trial balance. But we don't know that yet. That's in the next chapter. So from what we have, these are the 3 financial statements that we were able to come up with. So we did an income statement, revenue minus expenses, came up with net income. We then took that net income and brought that into our retained earnings statement, added it to our beginning retained earnings, subtracted out our dividends, and we ended up with ending retained earnings. We then set us up very nicely to do a balance sheet. In the balance sheet, the goal was to figure out, do our assets equal our liabilities plus our stockholders' equity? Our assets added up to 66.2. And fortunately for us, when we added our liabilities and our equity, it also added up to 66.2. Okay. And just a quick reminder, the whole secret to letting this whole process work was knowing our debits and our credits. And the only way you can know your debits and your credits is you got to know what an asset is. You have to know what a liability is. So if I say, hey, what's accounts payable? Do you know that's a liability? If you do, then you can automatically say, okay, liabilities, that's a liquor account. Liquor accounts go up by a credit, they go down by a debit. What's accounts receivable? That's an asset. If you know that's an asset, you can immediately say, okay, it goes up by a debit, goes down by a credit. So you can know your debit and your liquor, but if you don't know what an asset is, how do you apply the rule? So you really, really have to know and be able to identify what's an expense, what's a liability, what's an asset, you know, what's considered stock, what's considered revenue. So if you don't know that, you know, you're not going to be able to apply these great little debit aid and liquor techniques. Okay, so I hope you enjoyed what I did here for you today, and good luck in your classes wherever you are in the world. And this is Dr. Sam signing off. All right, take it easy, everybody.